From Market Sofi's earnings, now that I've had a chance to review the Q, and also because I paid a pretty big error on my live cast the other day. So I wanted to go ahead and correct that as well. For whatever reason, I missed a zero when I calculated market cap, which does change things. Nonetheless, I am still pretty bullish on SoFi. So I will go ahead and give you that bias. Let's get to the disclosures and just get right into the numbers and what I saw. Past performance is not indicative of future returns. I'm long. I think I'm still long SoFi at this point, and monitoring it closely. It definitely had a good quarter and it jumped up to 11, and now it's like cratered back into 8, which is why I was like, maybe it's time to start coming back in on the run up. But I am actually starting to put this into my long-term holdings because of what I saw that happened in the last 2 quarters. And because I do think they may be the net beneficiary of all that has transpired in the banks. And it really has to do with, before I get into the numbers, I really want to mention that the reason that I feel that way is because when I listen to all of the banks that reported in the S&P 500, and that's relevant because given the 2 bank blowups, you want to kind of get a sense for what's happening across all of credit and across all of who can lend, who can't lend, who has capacity, who doesn't have capacity. And I saw a whole mixed bag. I saw some, and it has nothing to do with macroeconomy. It just 100% has to do with what exactly is the nature of your financing situation right now if you're a bank and you have certain attributes. And what I like about SoFi and what really drew me to it last quarter and in quarters previous is that I had no idea that the weighted average FICO score, meaning they have a whole set of clients with a whole range of FICO scores, but the weighted average 2 quarters ago was approximately, it was well over 700%. So I'm like, well, wait a second. Additionally, the other two attributes that they have that other banks don't have that makes them so interesting to me is they are 95% FDIC insured. So a run on this bank wouldn't do what it might do to another bank at all because the balances don't look the same. Their exposure to business, which is why so many balances are not covered by FDIC and other banks would not be the same. There's all these things that are not the same. And then the third thing is because up until like this quarter, really, they had been funding themselves primarily through debt. So their cost of capital was higher, but given other places that they were taking out costs, they were able to make very competitive loans. Now, because of what's happened, you see, which I will show you, the deposit numbers increase dramatically. But what they're giving an interest rate is actually comparable in many ways to what they were taking out to fund themselves before. So they actually have a net benefit, not a net negative relative to other companies. So all of that is oddly a tailwind to a company that's done like just quite amazingly, both before the environment was going to build itself into the company it is today and move forward. Now, I'm going to go through the financials. And now that I've been posting on Twitter on this, whereas had not in the past, I now kind of see better what public opinion is about SoFi versus what the bank actually is at this point. And so I'm going to try to weave that in as I address different things that are going on. Okay, so let's look at it here. 1 second. Let me see what's going on here. Let me go to the first one. So the income statement is probably it's interesting because all bank financials I know can be very difficult for people to read. That is what it is. Oh, well. And so the income statement maybe looks a little different for some people than a classic income statement because you really do have 2 sources of income for a bank. You have interest income, which is the spread that you're making, giving your funded cost and what you lent it out at. And that's up 214%. Why is it up 214%? It's up 214% because their cost of capital and their funding is totally different. And they haven't had problems the same way that other banks have had problems in increasing that financing or getting deposits. So they're able to make loans right now when other people can't. I mean, literally when I say other people can't, I mean, other people didn't have a lot of banks are only 50% FDIC insured because the bulk of their business is business banking. And so business banking is commonly going to be over the 250,000 in FDIC insurance or whatever it is additionally that they might be able to get to help cover that. So SoFi doesn't have that problem, basically. So SoFi can continue to write loans, whereas the other banks are actually offering significantly higher rates, not because that's the correct risk, but that's the correct risk to them as a bank right now, given the mix of capital that they have, namely deposits that have a very particular characteristic of potentially walking out the door. So if I didn't have quite that same issue. Okay, so net interest income up 214%. I don't see that as a one-off for them is the issue. At a minimum, it's going to map through for the next 3 quarters as we compare to last year. So that's going to continue to look great. Origination and sales, it's down slightly on the quarter. So if you look at the second source of revenue, fee revenue, every finance company has fee revenue. That's everything that isn't the loan itself. So you make money on the loan, but maybe you charged less fees for origination. That's going to happen if you're originating directly from the bank versus originating from some originator where you then have to pay them kind of a finder's fee. If you think about it, it's like a sales fee. So the origination numbers, the fees came down, and some of that is the way that they do it, but the actual number of loans written, the volumes went up. And just in case you were unclear, even on the release, they printed it pretty clearly. Lending segment total origination volume increased 37% year over year, 1.3 billion record personal loan origination. So there's no weirdness that's going on in that business. They might just be charging less, passing it through to get the business permanently for their company, and so on and so forth. That's really where most of the fee-based revenue decline of 14% came from. I don't have a problem with that because really these two things map together as the net charge to a customer when they're doing business with your bank. The expenses, you had margin expansion, and you can see that if you do each and every single one of these line items, none of them are 37.5% in increase. So what does that mean? That means that just like you would expect, this bank is getting economy of scale. Okay. And a huge component of the story is the fact that because of the manner in which they solicit their clients or otherwise get their clients, and because of the way in which they conduct origination in other words, using technology, that sort of thing, versus handwritten, and then it's got to go to some back office. Then you've got to competitively bid it in some cases, or decide whether the bank wants to take it down. Because of the way that they're doing, which is a little bit different, they get economies of scale. Whereas a lot of banks oftentimes do not get economy of scale at some point when they're trying to originate the loan. Okay, so and then cost of operations is being streamlined, and G&A, all that stuff, economy of scale is what's happening there. And then I put this here because I do think this is important. A lot of folks are worried about the market environment. I'm going to show you because the provision for credit losses. This is a huge number. Okay, this number is, and there's several different things that you would look at, but most of the detail is going to be in the Q that was posted after earnings, which is typical. You usually post a Q afterwards. It is not going to be in the earnings release, but they are continuing to provision for credit losses. At first, I didn't think this was a big number, but then when I look through the numbers again, I'm like, no, actually, they're provisioning pretty aggressively, even though you still have a weighted average FICO score that is pretty high. All right. And then you have an L still for this year. They plan to be profitable in Q4. However, because of the nature of this bank, for most banks, you would not be able to think in terms of EBITDA. You wouldn't be able to think in terms of EBITDA because, first of all, what is interest to a bank? It's actually earnings. It's not a subtraction. And what exactly is depreciation amortization when your assets are bonds? So it's a little bit of a funky thing. But in this case, the DNA that's really relevant to SoFi is the technology that's been, so it's not quite as bad. It's not ideal, but if you take out DNA, you end up with an EBITDA positive situation. I'll allow it, is what I'm saying. Okay. Now so I'll allow this 50 to 75 is probably, remove the share expense. I'm not going to allow that, but the 50, I'll allow it because quite frankly, the 50 represents probably the tech stuff. Okay. So that's kind of how I'm thinking about that. Other people may disagree. And if you know better, hey, listen, I actually read every single one of these notes. And a huge component of why I'm doing this is because someone caught my error in the last video. And so I wanted to make that correction. I do appreciate corrections like everybody else. Okay. So a couple different ways to think about the size of the provision for loan losses. Okay, here's just one ham-fisted way to do it. If you ever are just looking at the earnings release and trying to figure it out because the Q isn't provided or they didn't put that information, you could look at the total loan originations that were made and then what the provision is. And you can get a sense that this is really high given that this is supposed to be and is currently showing as and acting like a book of investment grade loans. So 12% would be a huge number to reserve in cash on the off chance that 12% of the loans went to zero. That's sort of things that you have that it's a cash buffer, essentially what it is. However, the reason you can't go by that is because typically there's already an existing cash buffer, and what this provision for credit losses is adding into it or what have you. And if we get past this crazy land period that we're in economically, where people are really freaked out about the uncertainty of what's going on, if we get past all of it and things calm down, these provision for credit losses are going to be released. That is very common. And if we start to get like chilled out inflation and chill out on the rates, then you would release all of these credit losses and they would look like a massive gain on the income statement in future years. Or alternatively, this provision for credit losses cost item, let me show you again, this provision for credit losses right here, this line item goes to zero and you get this massive uptick benefit in future years for earnings. So we watch provision for loan losses right now because we're interested in what the bank is doing to shore itself up. But realize, even though I'm saying this is a really big number and I'm really, really cool with them taking it in, we'll go back to it in a second. Worst case scenario, no losses happen if you feel like they're taking in too much and they release it in subsequent quarters. So this earnings it just acts like a total like shot put for them. Probably using the wrong adjective, but there you are. Okay. Let's talk about well provision. Okay. This is CET capital ratios. Now, it's interesting because I still think CET capital ratios are relevant, but given what transpired in March, you kind of have to think about it a little differently now, just to give you a sense for walking it through. And I like how they presented it. This provision, okay, what's really amazing about this is when I go back into the financials, there was a period where the CET was right at the required minimum of 7%. They're not playing that game right now. They're at 15% required. And that's despite the fact that of all the banks, I would say their business looks like it's still in growth mode. I don't see that in other banks. And as a result of that, they are taking share. There's no other way to really interpret it than they're absolutely eating the mess of other people in a glorious way, not in a bad way. Okay, so tier one cat risk 15.8% is higher than even a Goldman Sachs right now and is about in line with JP Morgan, just as an FYI. It's a very high number. However, you don't really compare CET like that. You just use it to get a sense for it. A typical normal chilled out period, which we never go back to with the banks, would have been about a 10% CET reserve ratio. The leverage, this is a little bit deceiving because what it is your CET divided by your total assets, okay? So tier one leverage, the higher the better. 4 is the requirement. 5 is probably more typical, okay? But 16 is crazy. So they have plenty of cash. And the reason they have plenty of cash, and he talked about it on the call, you can see it in the balance sheet, is they ended up getting a bunch of deposits, all right? If you look at December, they had 7 billion deposits. Now they have 12 billion in deposits. And I really can't possibly explain well enough what I mean from the beginning of this, in that they benefit from the fact that their mix of capital before was not as exciting as the other banks. Okay, so let me take it off of the main screen really quick just to kind of explain this to you. Here's the deal. Most banks before all of this mess funded themselves with deposits. And what they did last year was they basically did not increase your deposit rate. Everybody kind of felt this last year because everybody's like, how is it that the Fed has raised rates 200, 300, 400 basis points, but my bank account is still giving me like jack nothing on my deposits, right? So that's how the banks used to fund themselves. And so during that period of time, when you've got this held to maturity crazy going on, that spread was basically, they were making up for some of it financially would have you by the fact that they were giving you their funding cost was still more or less low so that they could figure out what to do and pray that the Fed would stop, which it did not. Okay. So then fast forward, Silicon Valley Bank happens, and now everybody's got stable deposits by giving you a higher interest rate. Okay. I want you to look very carefully at this balance sheet that SoFi is rocking, because they don't have the same issue that everybody else has. 7.2 billion in deposits to fund the bank, and then 5.4 billion in loans. So they were funding fairly aggressively using debt, not deposits. So now that, and as many people probably know, the interest-bearing deposit, like the deposits here, look at it, you can just see it. Interest-bearing deposits has always been their deal, right? They've had very little non-interest-bearing deposits. If you compare this to another bank, you will see the same mix. So all along, rates are rising, they're doing their little thing, and then suddenly you've got a bunch of competitor banks who have margin squeeze, right? Because these other banks aren't used to paying an interest rate to fund them, to maintain their capital. So the spread that they're making between the cost of capital and the loan slaps right together like a sandwich. Okay. Not so for SoFi. This is what it is, like such a beautiful thing for them. For them, they're like, oh, cool. So it turns out that you guys now are cool with my deposit rate, which I always had to give at a higher rate. I'm used to giving it. And so I actually can change my mix from debt, which is kind of a pain, especially since I got to get it from this other avenue, to deposit financing, which actually happens to be lower. So strangely enough, they're like the one financial that I've looked at, and fair and square, I don't look at every financial on the entire earth, but I do look at all the ones in the S&P 500. They're one of the few where things actually improve for them. It's so freaking cool. Okay. It's so freaking cool. Okay, I'm seeing some really great comments in the chat. Please keep commenting, guys. I really appreciate it, because I will acknowledge and get back to every single one of those comments. But yes, you're right. I also did not see any CET improvement this last quarter. It's pretty amazing. So this is like a crazy strong situation. Okay, and then this, if you really were to, like, I just made the cash flow from financing side bigger so you guys could see it. 5.3 billion additional net change in deposits. So this will map literally directly back to if you did that subtraction. So I even feel like doing the math because I'm lazy, whatever you want to call it. And then you can see that they did about $1 billion in additional debt versus taking in 5.3 in deposits, which is at a lower rate than their debt facility probably would have been with, or equivalent. But I believe they said on the call that it's slightly lower. And I think that's crazy cool, to be honest with you. That's why this particular episode is entitled SoFi might be the net winner of the Silicon Valley Bank blow up. Although in fairness, JP Morgan probably takes that title, but you know what I mean? Okay. Well provisioned, like I said, let's get through some of the rest of this. Okay. For anyone that wants to do a deeper dive on this, and I think everybody should do a deeper dive, if for no other than I'm super into having more thoughtful conversations, because your dive might give me more details. But in the queue, there is a really great demonstration of what's going on with credit losses. Actually, I would argue that their demonstration of credit losses is comparable to any of the better banks. And in some cases, there are some regional banks that don't even do as good a job. They provide all the details, but they're not articulated and crisp the way that SoFi has done it. So you can kind of see here the credit card losses, the consumer losses, the accounts receivable, and you're getting really baby write-offs charged against the allowance that is so they're provisioning 12, they got 10 on credit card losses here, balance 37. This is basically just the charge off balance. So actually, let me make sure so this is unclear. This is not the total loans that they wrote and what's being charged off. This is the account that is for charge offs and what they provisioned, which at the beginning of period was 37. They added to the bank account, and then some write-offs happened, and ta-da. So they end with, you can see how it ends, right? So they started coming in a little bit light in December 31 with 7, and then they took in they were like, you know what, let's just buffer that. They only experienced 7, even though they took in a much bigger buffer. And also remember, they took in that bigger buffer because they wrote a whole mess of loan, like they wrote a crazy amount of loans in the last 6 months. So this is really wonderful. I encourage you, if you're going to do your research on this and truly due diligence, to look through this extensively. And obviously questions in the comments if when you look through it, and we can look at it together. I also liked it this way. Typically, what a bank does is they'll just give you the percent of what's going on in the book, and they'll do 30, 60, 90. This is a little bit different, and I almost wish they showed both so you could kind of compare and contrast. 30, 60, 90 is like the loan's been a little bit past due for 30 days. Maybe they didn't have their setting on their bank account to auto pay it, whatever it is, right? But you can see that so the way they do it is pass, watch, special mentions. Pass, there's no problem. That thing is going to pay off. Okay. Like at this point, there's zero risk. That thing is behaving exactly as it should. Watch is there's a little bit of weirdness, but it's not anything that makes me concerned because the balances are still good and everything is still good. Remember, a lot of people that are taking out loans from SoFi also have a bank account with SoFi, as well as maybe even other stuff with SoFi. So that does give them a much more beautiful blended picture of the client. Okay. And then, so you can see what's happening with the watch category. It was a little bit higher in 2022. It actually decreased for commercial real estate. And then residential real estate. This is okay. Before you freak out and you're like, oh, the real estate portfolio, realize that the real estate portfolio is the smallest set of loans that they do. Here's the loan mix. Personal loans, by far, if you were like, May, what does this company do? The answer is personal loans. And I really want to answer it that way because I did not realize it, because people have not looked at this in a long time, that they thought this was primarily a student lender. This is your loan mix. Okay. So they are definitely not like relative. Personal loans is 1/10 almost the size of the I'm sorry, student loans is 1/10 the size of the personal loans business. And then home loans is really, really tiny. Now, I want to do a hard pause on that as well. I want you to understand something really important about SoFi when you go to compare it to other banks, because someone also mentioned this to me. They're like, well, May, if the FICO score is higher, then the loan spread is lower. And yes, statement by itself, true. Okay. The part that's not correct or is a little bit of a manipulation there is that most banks don't have consumer personal loans as the primary area for which they're lending. Most have either commercial real estate loans or even residential loans. It's mostly mortgages. And this one, even like you can check it to get it precise. Absolutely, SoFi gives you their average rate on their credit card book and their personal loan book. But if you check any bank, the mortgage rates are always lower than personal loan. And there's lots of reasons for that. The first reason, the most obvious reason, is that mortgage loans are asset backed. You get to reclaim the house. And so technically they're higher risk. But in actuality, when you look at what it looks like on a bank, it's still a risk. Okay. It's not riskless or less risky or less likely to default. It's just that what you'd provision against it is different. Okay. So the rate is lower. But realize as well, the second reason is that the loans are actually subsidized under Fannie and Freddie. That's often ignored, but that's true too. Personal loans are fully unsecuritized, so the way you provision against them is different, which is probably why SoFi is being conservative and doing closer to 15% CET capital ratios. Okay, so that's what's going on there if you're trying to understand it. Regardless, the loans, let me show you. This was from the previous quarter. I did not pull it off for this Q, but this was from, I think, a quarter ago. This is what your rates would look like. So this was year end. Okay. At year end, the weighted average interest rate would have been 11.82%. So the spread, now it's mostly deposits of 3%, and 11% is actually your net interest income minus all the other costs, et cetera. Okay. But you can just tell that if you're mostly writing 11% loans versus you're mostly writing home loans at 3.4% at the end of the year, hedges with interest rate hedges, okay, then you've got a very different profitability look and feel to it. And typically in other environments, you'd be like, oh my gosh, personal loans so risky, so upset. We really have to do extra work on the provision for loan losses, which I've shown. In this environment, because of the nature of duration, because the home loan has a 30-year component to it, and the personal loans don't. Okay, now some of you will correct me because most people do not hold home loans to maturity, but in this environment, you kind of got to think about it differently. But because of all of that, because actually personal loans are the better loan to hold right now relative to these other two categories. And also, as we know, student loans no longer having the issue that we had before where we couldn't figure out as a nation what we wanted to do about student debt. That will be paid back. And again, I like to show this slide when everybody's freaking out about student loans and how awful it is. The weighted average origination for the weighted average interest rate of the loans that SoFi is giving out for student loans is 4.25%. Okay. So stop whining, for lack of a better way to say it. Right now, it's fine. We're not talking, it's not even the 11% personal loan. Also, I want to just go ahead and say this. If for some reason you go and check your student loan and it is not close to that 4%, let's call it 5 or 6% now, but it's much higher than that, then I will put a link in the show notes to SoFi's student lending page so you can consider and see if you're eligible for a lower rate, because their rate is still their rate is still going to be lower than some people telling me they had a 7-8% rate. Okay. Refi that thing. All right, cool. Let's see. I think that's about all I have. Oh yeah, I do want to go through valuation because that's where I made my horrible error. And I got to own my errors just like everybody else does. Here's the funding mix. 36% comes from debt financing now. Yeah, don't worry about that stuff. Okay, let me see. All right. That was from last quarter. Okay. So on valuation, this is what I'm seeing. This is where I messed up. For whatever reason, I calculated the market cap completely wrong. 836 million shares, currently at $8.40, is a $7.8 billion market cap. That gives you a price to EBITDA. Don't love that metric for banks, but hey, you got to work with something because they don't yet have earnings and they have so much DNA that comes from a place that's very different from other banks. So that's 23 times. And then book value, which is total assets minus total liabilities, you're going to get to 1.3 times book value. You can take off the intangibles, 12 million. And I actually am okay with this book value. If anything, I think this is undervalued because given what I'm seeing in the first of all, the growth of deposits, the growth of the loan book, and the growth of the statement altogether, this book value, if next quarter looks like this quarter, is going to shrink considerably. I mean, we have almost like let's just look at it real quick. We have 5 billion more in deposits. So they grew deposits by 5 they grew deposits crazy on the quarter, for lack of a better way to say it. And if they do it again in this next quarter because people start to get freaked out about their bank, or they just want a better rate, or any number of reasons, then you're going to see some massive economies of scale. So I'm actually okay with that. And that's it. Okay, now let me acknowledge all the people. Sorry that was one big long thing. Wesley, yeah, it's below 9, which is why I was like, you know what, given the error that I made, which is a market cap error, which means all my valuations were off like crazy. Apologies. Let me just redo the video. Plus the Q came out. But under $9, that's what it looks like right now. And you can take some thoughts on what you think, realizing that relative to all other banks, even JP Morgan, it is growing significantly faster and will probably continue to benefit in this environment. Oh, Maximus, thank you so much for coming. You're the best. I appreciate the support. Anya, thank you. And then Rick, you have so many good comments here. Agreed. Adjusted EBITDA is important. Yes. 10Q was released about 2 days ago. Yeah, I know. I'm so late, but thank you for thank you. It sounds like you also are looking at this thing like a champ. Yes. First ever improvement, total loan sales over 400 million. Yes. Agreed. It's a really strong quarter. Like, I don't know if anyone is confused at that. How long until how long until SoFi runs out of capital if they don't sell the loans? I believe they'll wait for interest rates to drop before selling more. I'm actually not worried on this. And the reason I'm not worried on this is because essentially if they almost doubled the amount of deposits relative to relative to last year, then it's as if you had an infusion of capital, a massive infusion of capital. So there is no consideration for running out of capital at this point. That's done. That's what makes this so amazing, and that's also why they were saying that by year end they're definitely profitable in the second half. And so hopefully that answers that question, Ricky D. If you have a different opinion, though, I want to hear it. So definitely let me know if you feel like I've missed a thought process there. CAC also decreased quarter over quarter. I hope this trend continues. I'm not 100% sure with this abbreviation. It's interesting. Is that cash? I don't want to double. Let me know what that abbreviation means, because what's interesting is that I noticed that there's so many acronyms across different industries as well as across all of finance, and some people abbreviate stuff that I never would have thought to abbreviate. But it doesn't mean that either of us is. It just means that you're just more accustomed to abbreviating certain things, and I'm not accustomed to abbreviating it. Okay, so hopefully that answered the questions. I appreciate you guys. Thank you for letting me know. If that person that saw my error the other day is watching, thank you so much for letting me know. And good luck in these markets. It is still crazy. And August, I think, we're finally getting our sell in May and go away kind of situation happening. I'm almost through all the S&P earnings calls, so I will start making videos more consistently, although I am enjoying the beautiful summer in New York. It's been so much fun this summer. Customer acquisition costs. Thanks, Ricky D. Sorry. Yeah, it's true. It has decreased significantly. Thank you, Ricky D. You're totally right. That's a huge thing to point out. And that is 100% related to this kind of new paradigm of an environment. So it's yet another reason why I think as long as they run this bank like a champ and they don't run this in some funky, untoward way, then I think that they will continue from here forward to grow their reputation for being a safe bank. And since they're so young, that could be a really big deal for them. Oh, the other thing I didn't mention is that they do the investment banking business now. And my suspicion is for younger companies in particular, they will be fine with going through a SoFi and having retail be the primary end buyer of the stock versus the expense of going to a much larger bank. And so that the investment banking business, if done carefully, could actually be hugely beneficial if we can get out of this crazy environment. Because I will tell you this, most of the banks have not, the layoffs of investment bankers have declined, and some are actually hiring, because as soon as anything comes off the pedal on the Fed, there is a desire to recapitalize or adjust capitalization, or more importantly, to buy another company. There's a lot of companies that are massively cash rich, and all of that means that if you have a banking business, after the turn, the banking business usually shoots up first, and then you see everything else in a banking financial statement. So hopefully that's helpful as well. I don't know if I explained that well. So yeah, super cool. All right, I'm going to end it. Have an amazing weekend, everybody. Enjoy the summer. Take care.